If you've been paying attention to interest rates, you've probably heard two very different stories lately. On one side, inflation is easing and unemployment is still high, which sounds like rate cuts should be coming. On the other side, some economists are already talking about rate hikes towards the end of 2026. So, which one is it? Today, I want to break down what the Bank of Canada is actually telling us, why cuts and hikes can both be part of the same story, and how to choose the right mortgage strategy for 2026, even if rates don't move. Let's start with what just happened. The Bank of Canada held its policy rate at 2.25%, which keeps the benchmark prime rate at 4.45%, unchanged again. Most important, their inflation outlook is very calm. They expect inflation to stay close to the 2% target. Core inflation to ease towards 2.1% by year end. Translation: inflation is no longer the emergency it was. So, if inflation is under control, why isn't the bank cutting? Because inflation isn't the only thing the bank watches. Canada's economy right now isn't booming, but it's not collapsing either. We're kind of skating along the edge. Unemployment is still elevated. Businesses are cautious about hiring. Population growth is slowing. And housing supply is finally increasing in some markets. The bank has even said that excess supply is holding inflation down. That's why they're comfortable waiting. They're watching to see whether growth stabilizes or slips. This is where the confusion can come in. If inflation is heading towards 2%, why are some economists still talking about rate hikes later on? The answer is one word: neutral. The Bank of Canada believes that 2.25% is sitting at the low end of neutral. Neutral means rates aren't slowing the economy, but they're not stimulating it either. If inflation stays anchored and the economy finds its footing, not overheats, but stabilizes, the bank may eventually want rates closer to the middle of neutral. That doesn't require inflation to rise again. It simply means the emergency phase is over. That's why some forecasts show no cuts soon, no hikes anytime soon, and possibly very gradual increases well down the road, likely in 2027. You may hear that markets didn't really react to this announcement, and it's tempting to think that means nothing's happening. That's not quite right. Markets didn't move because the bank said exactly what investors expected, not because risks have disappeared. We're in an extremely volatile global environment. Trade policy is unpredictable. Growth is fragile. Inflation is behaving, but not locked in. So instead of pricing big moves, markets are watching closely and waiting. Bond yields stayed flat, which affects fixed interest rates, and rate expectations barely shifted, which tells us this: not that things are calm, but that markets are on alert, waiting for clearer signals. In this kind of environment, rates often stay still right up until they don't. That's why certainty matters more than predictions right now. This is where I want to shift the conversation. Right now, you're not choosing between do I catch the bottom or do I wait for cuts? You're choosing between certainty versus flexibility, payment stability versus optionality, short term comfort versus long term strategy. If rates stay flat, fixed rates appeal to people who value predictability. Variable rates appeal to people who want flexibility and can tolerate movement. Neither is automatically better. The biggest mistake is choosing a mortgage based on a forecast instead of choosing one based on cash flow, job stability, family plans, risk tolerance, and how long you realistically expect to keep the mortgage. In a market like this, structure matters more than the rate itself. So when you hear talk of cuts and hikes, remember they're not contradictions, they're reflections of an economy that's adjusting, cooling, and trying to find balance again. 2026 isn't about guessing where rates go next. It's about choosing a mortgage that still works, even if rates don't move at all.